The following interview segment was taken from Talking Wealth on flix.net. That's FLIXX.net. Talking Wealth is brought to you by Wealth Within and presented by Dale Gillham and Janine Cox. To watch a full episode, go to flix.net and click on Talking Wealth under the business and finance sections. Or for more information, visit wealthwithin.com.au.
Eric Brotman, welcome back to Talking Wealth. How are you today?
I'm doing great. Thanks for having me back.
Oh, that's great. Look, we're excited to have you back on the show again. You know, it's been a while since we've had the opportunity to chat with you. How have you been and what's been happening in your world?
I've been well, and the world is starting to heal from some of the pandemic challenges that we've had, and markets continue to be good, and the economy continues to be strong here in the States, and so right now things are feeling pretty good.
That's fantastic news. Look, with the explosion of COVID around the world, the past year has been one of change, and in so many areas of our lives, in the way that we work and in the way that we live. So today I'd really like to get into a few areas that will help our viewers in the next 12 months as we move forward and out of this COVID period. So I've got a few questions for you. Ready to go?
Absolutely.
That we're hearing lots of reports at the moment regarding fears of inflation and rising interest rates, both of which affect our lifestyle and investing. So can you share your thoughts on the impact of rising interest rates on the US and the global economies?
Absolutely. First of all, I think it's a reasonable expectation that interest rates will begin to revert to a more normal level. They've been artificially low for a very long time, and in math it's called reversion to the mean. But realistically, what I think is going to happen is we're going to start to see interest rates go up, and there's an entire generation of investors who don't remember inflation. It's been a long time. And so there will be some trepidation, there'll be some fear, there'll be some almost confusion by folks who've not seen it before, and hopefully they'll listen to those who've been through it before. But in terms of the markets, my biggest concern regarding interest rates is in the fixed income markets.
Okay.
It's lending. When you're lending money in a low interest rate environment, it means that you're locking your profits up or your yield up at a time where rising interest rates are going to hurt market prices. So it is predictable that intermediate and long-term bonds are in harm's way during this period of time. So I think it's a really good time to shorten the duration of bonds. Or to try and lend at a variable rate, looking at private debt instead of public debt. I don't think inflation is necessarily going to be dreadful for equity markets. I'm not sure that it's going to be related at all.
Yeah.
But on your cash, on your fixed income, it's going to be real important to stay short, to stay liquid, and to stay flexible, because as interest rates go up and bond prices drop, it's going to be an opportunity to buy and improve your yield. But what you don't want to do is sell them at a loss to do that.
Yeah.
So holding till maturity will prevent some of that. So that's I think the number one obvious thing. And then there's also going to be an impact on real estate and other investing. If you're buying, this is still a great time to buy and to do it at a fixed rate when you borrow. It's just not a good time to lend.
Yeah, I mean, in the case of bonds, do you think it's important that people have that mix of investments across stocks, bonds and property? Or is there an argument to say keep it really simple and just go for what you know?
I think sometimes the devil's in the details, and what you know isn't always good for you. Just because you understand it better and it's familiar to you doesn't necessarily mean it's the best spot. I think diversification does matter. I think asset classes matter. And I think most of that has to do with the time frame involved. For young people, for people in their 20s, 30s, 40s, there's really not a great need to hold bonds on money that you're planning to continue to grow for the next 2, 3, 4 decades.
Absolutely.
There's no point. But if you're in a position where you're either living on your assets and the income that your assets produce, or you're thinking of retiring in whatever traditional sense that means to you, and you're going to either reduce your earnings or eliminate them entirely and have to start growing or using your portfolio to do it, it's imperative not to be in all stocks or in all illiquid investments either. It's good to have some balance. And the money you're going to need in the next, say, 5 years at least should be liquid and boring. You don't need a return on that capital as much as you need the return of that capital when you need to use it.
Now, I mean, stocks are considered high at the moment. So there's been all this talk of the stock market coming back, but the stock market keeps going higher. Governments continue to pump money into the economy. Interest rates are so low. With interest rates so low and inflation so low at the moment, and the Fed saying that they were unlikely to change the status quo until 2023, do you see that you're saying that you don't think it's really going to affect the stock market too much? And from our point of view, we've been expecting at least a short-term pullback. The low into the COVID was quite a strong one, which means that in theory the market should go up for between 2 to 4 years from a low like that. Of course, you'll have pullbacks along the way, but so the stock market should continue to be strong. So what are your thoughts in relation to what the Fed's planning on doing and how that will then affect stocks, bonds and property?
Well, on the equity side, on stocks, as long as the government is propping up the economy and printing and spending money, there will be, I believe, a relatively strong stock market, but that can't continue indefinitely. At some point, that bill comes due, and it usually comes due in the form of higher taxation. And I know in the U.S. right now, there are some tax proposals that have investors watching in a very nervous way, I think, in terms of what capital gains tax might look like, in terms of what estate taxes and other death type or inheritance type taxes might look like. That's going to play a role. The equity markets are not, they're not poised to get hurt by a modest uptick in interest rates. They're poised to get hurt at the moment where the government spending stops and the consumers who have to then step up and buoy that will have a difficult time maintaining their spending if their taxes are higher.
Yeah, and at what point is that likely to happen? It's not for a few years yet, though, isn't it?
I think it's at least 12 months, but I don't know how much longer. I mean, none of us have a crystal ball, but there will come a point legislatively, at least in the U.S., there's an opportunity to do some to make some tax changes right now because one party is dominant in the U.S. political system right now. And so when that occurs, I liken it to giving either political party the keys to the steamroller. They can do whatever they want for a limited amount of time, and then there's always a pendulum that swings. So if there's going to be tax change, I think it's going to happen in 2022.
Okay.
And if that occurs and it affects the way that consumers are able to spend and therefore invest, it will have an adverse impact on the stock market. Okay,
so we're likely to see after 2022 potential for governments to make changes to taxation. Fed are talking about interest rates going up 2023, and that means inflation's going to kick in somewhere in between that period, isn't it?
I would think so, although I don't know that we're going to see runaway inflation or anything that's necessarily alarming. It's just been so long since we've seen a rising rate market. I mean, fixed income has been in a bull for 30 years. I mean, we're not talking about a short period of time. It's been an entire generation or two. And so when that begins, when we start to look at this like it's the 70s or the 80s, it will be a different environment for investing, for borrowing, for lending. And I think at some point we're in for a real tough stretch. I don't think it's this year. I don't even think it's necessarily next year. But I do think we're in for a stretch, and it's going to be important to immunize your portfolio as best you can with diversification, but also with making sure that you have dry powder.
Yep.
You have money on the sidelines for either opportunities or for a situation where you need capital and don't want to have to sell low.
Okay, thank you very much for that. I'm sure that will help a lot of people in terms of their planning over the next couple of years. Now, I've got another one for you. When following economic cycles, and this is really important, we know that it's best to look at the next stage of these cycles to determine what may be the best places to invest our money. Now, however, this is quite broad, isn't it? So such as stocks, property, bonds, and the like. And what I would like to ask your opinion on is, what industries do you believe are likely to do well coming out of the current pandemic so that our viewers know where to invest for the next year or more and really plan for that?
I think there are three that predictably, based on not only coming out of COVID, but based on demographics, are going to continue to lead the way. One of them is financials. The financial sector is poised to do very, very well when there is a transition of wealth. And the largest transition of wealth in human history is coming in the next 15, 20 years. So that's one. Another is healthcare. The population's getting older, and as the population gets older, more healthcare spending occurs and more healthcare innovation occurs, and there's more emphasis right now on healthcare than there has been in a long time, even pharmaceuticals, because of the COVID vaccine and so forth. There's a lot of pressure on these companies to continue to innovate. And so I think healthcare is going to continue to be a spot where investing makes sense. And the last, which is, it sounds so cliche, but it's technology. And the challenge I have with technology is I no longer think of it as a sector. Technology is everything. There is no industry that doesn't have technology. Agriculture is technology. Everything that we do is related to that. But the big providers of technological solutions, and particularly those that have been able to monetize this in a meaningful way, your Apples and your Microsofts, and they're not only not going anywhere, they're likely to continue to gobble up opportunity. And I still think there's a lot of run right there.
Yeah, I agree. I mean, that whole sector, that fintech area, while it's really hugely, seems inflated at the moment, I just look at what's going on around the world, just with individuals and what they're interested in and where things are changing, even in the workplace. How you drive your car and get to work, you name it, how you order your food. You just look at simple things around the house that are changing now, and we're only in the very early stages of all of this. And I think, when I was younger and I watched these cartoons where you'd see these future pictorial representations of what it would be like to live in the space age, we're only on the very bottom run of that yet. We're not flying our own ships around the world, and people might laugh at that, but at some stage we'll have automated guided vehicles driving us to work. We're on the really cusp of that already.
I think you're right. I joke often that at some point we're going to need to know where our hovercraft is parked. And just think of all the savings that will occur when, instead of building new roads in a way that's wide, we can build them up and have 2 or 3 tiers. The reality is some of that innovation is definitely coming, and it may be driverless. They exist. They're nowhere near perfected, and they're nowhere near available to the general population. But I certainly think there'll be some of that. It's not, though, only the innovation in terms of products like that. It's also innovation in ways that we do things. So you talked about driving your car to work. There are going to be lots of people who never have to drive their car to work again. A third of the population can work remotely entirely if their companies will allow it, and more companies are allowing that. And where that's going to create some really interesting shifts is in real estate, especially residential real estate outside of big urban centers, because it will no longer be necessary to live where you work.
And I'm wondering, what is that going to do to the cities? Just this change in apartment living, because at one stage apartment living was just so, it was just growing at a rate of knots, and it was particularly here in Australia and in the US, we're watching that happening. So I'm just suggesting that, and people are already talking about it, the big change that's likely to occur in that space.
There is a big change, and I don't know that population density is going to be popular for some time. So the idea of living on the 73rd floor of some enormous tower, I think, is less appealing than maybe ever before. And some of that is probably a good thing, because there's something to be said for green space. There's something to be said for having a little bit of a yard even, but there will still be a desire to have, whether it's condominiums or apartments. I think you're going to see more apartments for a while, because this entire generation, Gen Z, and even millennials to some extent, but definitely Gen Z, they're not putting roots down. They're not starting families as young as the generations before did. They're not staying at a job for very long. They change jobs every 3 to 5 years. And there's lots of problems with that for them financially, which we could talk about. But in terms of what it means to real estate, it means they're not putting roots down. So they're not buying.
Yeah, I was watching some property shows, sorry to interrupt, but I'm thinking that younger people and families are going to spend money on their properties like they never did before, and potentially try to keep children at home. and create all of these spaces so that kids, younger people will want to stay at home longer so they can feel a bit more independent in their own home. So that's something that I see happening, and I don't know if you've noticed that as well.
I haven't seen that specifically, but I'm not sure that I would agree that folks are going to spend more money on their homes to do this. I think what's going to happen is you're going to have real estate that is, some real estate's going to get more expensive, certainly, but they'll also, because of the ability to live further away from your employment or further away from a city, right now, there are still deals to be had there. You can still buy inexpensively. So where you'll see people spend money will be on the improvements, on the decor, on making that house a home, so to speak. But the land itself won't necessarily get more expensive quickly. I think it's going to be a gradual process, and I think there's opportunity.
Yeah. Well, look, so what you're suggesting is go for property, and are you saying that people should start looking at property over other asset classes at the moment?
Not necessarily over other asset classes, but in keeping with this, I think it's important to look at real estate, especially things that are forward-looking. Think about industrial space, warehouse space, any kind of distribution centers. You're going to see these proliferate across Europe, and as they do, it's going to be a significant opportunity for folks who get in relatively early, and it's still early in the game in Europe. It is not early in the game in the States.
Yeah.
It is early in the game in Europe, but there's opportunity there. I also think medical space is going to be important, and we're going to rethink office space. There's no question we're going to rethink it. And for everyone who says office space is dead because companies are going to let people work from home and so forth, they're going to have flexible schedules and everything else, there's also somebody who says, yeah, but the people who do come to the office are going to want more space. They're not going to be on top of each other. So some companies may actually need more square footage, even if it's not for more people.
Yep. So
and that's an interesting thing. I don't know the answer. I wish I did, but I don't. I think
still look for the good quality REITs, the companies that are in that real estate sector that are really looking at driving that dollar and getting, because at the moment with the interest rates so low and inflation so low, those types of investments are really good for the income side of things, aren't they, for people for getting those dividends?
Well, they can be, although I think we're going to see a turnover. We're going to see some vacancies. We're going to see a lot of pressure to re-sign tenants, and some of that will be at a lower rental rate. So I think we have to prepare that some of those funds are going to struggle a little bit by virtue of the fact that to avoid vacancies, they're going to have to either create incentives to keep their tenants, or they're going to have to lower some of their rental rates. So I think there's going to be some pressure on that for the time being. It's likely to be a better time to be buying new than it is to be holding something that you've held for a while. I think there's some assets there that are poised to get hurt a little bit when some of these leases end.
Now, there's always an argument out there for investors about whether to be short-term focused or to have a longer-term view. And, you know, constantly we're hearing this longer-term view, but do you believe that people should maintain that longer-term perspective when they're investing, or should there be a balance between short-term and long-term at the moment, given the state of flux that's going on in the economy?
I think it's okay to segregate your assets and to recognize that the long-term assets need a long-term horizon and the short-term assets need a short-term horizon. Money that you're investing that you need to use in 3 years, if you're investing money for an education fund for your son or daughter, you have to treat that differently than money that's in a retirement plan you're not going to touch for 2 decades. If you have a long runway, think long-term on all of that. But you don't have to treat every account the same or every asset the same. You might treat one of your retirement accounts differently than you treat an account for which you're saving or investing for a short or intermediate term need, for a vacation home or for education or for other priorities. But for retirement, I think you have to look at this as eternal. And the idea of retiring at 65 and only living to 72, thankfully, is long gone. We could live 30, 35, 40 years in retirement. So just because you're retired does not mean you're not a long-term investor. You may be around a long time. It could be a 30-year life.
Yeah, so, you've got to plan for that. You don't want to be living off bread and
anymore.
water. Yeah, you've got to make sure you've got the money there to suit everything, suit your lifestyle, suit the adventures that you want to go on. Post-COVID, I'm sure there are a lot of people who are wanting to get out and spend more money and go on holidays. So Eric, we're just talking a bit about short-term and long-term investing and having that balance. So if somebody's approaching retirement or they're already in retirement, what sort of areas do you suggest that people focus on for short-term as opposed to the long-term investing?
Short-term investing is tough right now. Yields are low, interest rates are low, cash is paying nothing, and so there's a tendency to be fearful of even locking money up in a certificate of deposit or other type of vehicle like that, and rightly so. I think it's important to maintain that short term and maintain a short maturity on some of that debt. However, I think it's also important not to use your basic mutual fund or basic pooled investment on fixed income. I think it's better if you have enough resources to choose individual bonds. This is a good time to do that because you can control quality, you can control maturity, and you can hold those bonds until they mature so that you're not hurt in the same way by a rising interest rate environment. The other thing you can do is you can look for exchange traded funds that have set maturity dates. So there are funds where all of the bonds, for example, in that fund mature in the same calendar year. And if you do it that way, you're much more likely to be able to hold them to maturity to at least receive your investment back in addition to whatever yield you've gotten, rather than being in a general mutual fund where people are going to be buying and selling all the time. In a traditional total return fund, for example, where you might have some bonds that mature next week and some that mature in 12 years, and they're all in one big pot, the problem with that is that a manager is forced, if there's a redemption of that fund, which you can redeem at the end of any day, if there's a redemption, the manager has to sell something in order to pay out those who want to redeem. Invariably, what's going to happen is interest rates will go up a little bit, bond prices will start to fall, and like lemmings off a cliff, people will start selling these funds in their retirement plans because they'll think they're dogs in some way. And as they sell, other investors are going to get punished for other people's bad behavior. Because if 100 people sell their shares of the fund and the manager has to sell bonds and you happen to still be holding the fund just sold bonds that were perfectly fine at a terrible time from a price standpoint because other people wanted to get out of the fund. So I would avoid your total return type bond funds entirely right now. And I would stick to things with a set maturity, whether it's individual bonds or whether it's exchange traded funds with set annual maturities.
Yeah, this is why people need to talk to you, because if we were talking before about you don't really need to understand everything about what you're investing in, but you have to understand the concepts of when things start to change, like interest rates change, inflation changes, and what's the impact on those, and just to understand the mechanics of what they're investing in. We find a lot of people in Australia particularly put their money into things without understanding those mechanics, and then they're not understanding the interactions like you were talking about before within the fund that other investors are impacting on their returns. So at what point will a change in the economics affect those people who are looking to get out of bonds en masse? Are we thinking that it's going to be a year or 2 years down the track when this could happen in the mutual funds?
Oh, it may not even be that long. As soon as the government stops printing money, and I don't know when that'll be exactly, but there will come a point where it must. When the government stops printing money, there will be some pressure to have interest rates begin to move. And when they do, bond prices will drop, and a certain group of investors will look at those funds and say, boy, this fund isn't very good. I need to sell it. It's down 3%, 5%, 8%. And when they do sell that, they're not only locking in a loss for themselves, they're damaging the portfolio for everybody else who owns it. And that's why paying for someone else's bad behavior is never good.
Okay.
If you make a mistake yourself, you live with it. But if other people are doing something maybe they shouldn't do and it hurts you, then that's not an investment I would want to be in.
Yep, fair enough. Well, thank you. Fantastic. That's really great advice, and I'm sure people will take that and hopefully they won't panic and they'll be quite relaxed, and they might have to contact you to understand a little bit more about that. Eric Brotman,
Definitely.
I've really enjoyed our chat today, and thank you very much for that informative information that you've given us. I'm sure people will be thinking more longer term and have a balance there with some shorter term perspective and its purpose. It's what you're saying is have structure things so that you're set up for purpose, fit for purpose. Yep.
Absolutely true.
Now, before we go, can you please tell everyone where they can find out about you? It'd be great if they could have a look at and see what you're all about so they can understand a broader picture for what you do for clients.
Absolutely. And I'll give you two spots. One is brotmanmedia.com. That's where you'll find my book and podcast, both of which are called Don't Retire, Graduate. And it is meant to redefine what retirement is and maybe what it isn't. And our firm is at bfgfa.com. It's BFG Financial Advisors. And there's a ton of inexpensive and free information there, ebooks, white papers, even a financial literacy course that's out that's free for young people mostly who want to learn some of the basics. So I hope people will check us out.
Okay, Eric Brotman, thanks for being on Talking Wealth, and we look forward to chatting with you again soon. Take care. Bye for now.
Take care now.
For more information on our guest in today's episode, visit the link on screen right now. For more Talking Wealth, visit flix.net and click on Talking Wealth under the Business and Finance section. That's flixx.net. Or visit wealthwithin.com.au, where we have hundreds of informational videos, live shows and Talking Wealth podcasts. Talking Wealth was voted number 3 in stock market podcasts globally in 2018 by FeedSpot. For more information on our courses, visit wealthwithin.com.au.